Hi, this is James Shug with Westpac London's end of day report for Friday, May the 4th. Another down day on equity markets, I'm afraid, with the European session starting off with some softer news on the services sector, actually a revision to the previously released April services PMI, but quite a substantial downward revision, bigger than normal. That meant that the composite PMI, which includes manufacturing, fell to its second lowest level since the recession of 2009. It did dip in October last year to just lower than today's 46.9 reading. Sorry, 46.7 reading. It was a little bit lower than that in October last year, but that was when the banking system was freezing up in Europe, and it was before the ECB cut interest rates and announced the long-term refinancing operations. So we're pretty much back to that level now. The last time it actually fell to the current level prior to October last year was in September 2008, around the time of the Lehman Brothers collapse. It subsequently plunged, of course, as global trade collapsed. But the recession in Europe had already been running for 2 quarters at that stage. So this is another indication that Europe didn't experience just 1 quarter of contraction. It looks like there's an ongoing recession in Europe, and that's very much our view for this year. The other major news today was the jobs numbers in the US. Payrolls grew 115,000 in April, a bit weaker than our 130,000 forecast, and quite a bit weaker than the 160,000 consensus. There were upward revisions to the previous 2 months, but they just actually served to accentuate the downswing in jobs growth since the middle of the first quarter, when jobs grew something like 260,000 in February, down to now, just 115,000 in April. Some of the detail on the report was interesting too. It sort of shows how the weather probably was a factor at play. Construction jobs have been posting small losses in the last few months, having posted very large gains around December, January, when the weather would have normally been the coldest. So maybe there wasn't the usual layoff. There weren't the usual layoffs taking place at that time. That boosted the numbers after seasonal adjustment, and now we're getting the payback. Leisure is another one. Very modest jobs growth in the last month, or in the latest month, after very strong jobs growth through the first quarter. Although there's some structural weakness there showing up again. That's like government jobs, which are continuing to decline after sort of stabilising temporarily. So basically, we regard the jobs numbers as further confirmation that the US economy has lost some momentum since the start of this year. One other point to note was that the separate household survey, which they used to calculate the unemployment rate, it posted its second consecutive decline in employment after running 8 consecutive gains in the period up to February. So more evidence from that survey too that things have lost some momentum. One or two bright spots: the unemployment rate actually fell from 8.2 to 8.1%. That was because just as many people that lost their jobs, it seems, on top of them leaving, just as many people that lost their jobs. Let's start that again. The number of people that lost their jobs was only half the number of people that actually left the labour force in April. So a lot of people that were previously classified as job seekers actually just gave up the hunt and therefore weren't counted as unemployed anymore. So we saw on the household survey, what was it, 169,000 people losing their job, and we saw 174,000 previously unemployed people leaving the workforce. So that's why the unemployment rate actually fell despite the decline in employment. In Canada, the IVY PMI in April fell very sharply from 64 to 53. Tempting to ascribe that to maybe weather conditions being favourable in the winter and then normalising. But I think a lot of it's to do with the auto sector too, where we know that auto sales have been manufacturing has been particularly strong, related to the shortage of cars following the tsunami in Japan last year. That's now largely corrected, and so we're seeing a bit of a downturn take place in the auto sector. That would have also helped to explain that. And that's about it really in terms of the data flow. Just run through the markets today, not pretty. We've got the FTSE in London down 2.1%. This isn't quite at the close, by the way. It's just 10 past 4 when I'm doing this report. French market down 1.9%. The Germans off 1.9%. The Spanish managed to fall just 0.1% today, and the Italian market off 1.6%. And the Dow at the moment down 0.9% at 13,092. In the commodity markets, oil off a very steep 4.4% today. We're looking at sub $100 again there, a barrel, to $98 a barrel. Copper prices are down 0.6%, and gold is a little changed at $1,636 an ounce. And the Aussie dollar, well, it's just had a bad run, hasn't it? It's at 1.019 against the US dollar. That's the lowest for the year so far. Basically, it was around that level at the very end of December. It rose quite sharply in the first couple of months of the year, but since then it's been drifting lower as expectations about Reserve Bank interest rate cuts actually crystallised into cuts, as we saw in earlier this week, with the Reserve Bank monetary policy statement today hinting that, or implying at least, that interest rates could probably fall further, given their very low forecast for core inflation. And with today's news on the global economy, the European PMI and the US jobs story, not solid either. So the Aussie dollar, as I say, back below 1.02 for the first time this year. And that's it from me today. Apologies about the sound. Apparently it's a bit quiet. We're going to try and rectify that. And there won't be a report on Monday because it's a UK bank holiday, celebrating May Day, which of course was this week, but we like to stick it on to the end of a weekend. Okay, so I'll speak to you again on Tuesday.